Rohit Srivastava, the founder of India Charts, joins us this morning. Rohit, good morning. Pleasure having you here with News 9 this Tuesday morning. Help us understand, put into perspective the charts that we are seeing on the screen and the numbers that we are seeing on the screen. What do retail investors make of this? Is there a trajectory that can be outlined on where markets would be headed from here on?
So you see, the near-term trend has been down, and I do believe that we can continue to see weakness in the weeks ahead into maybe mid or end of September before we start getting a meaningful recovery.
Okay.
In terms of levels, I think till we don't cross, say, 24,700 in the near term, we could still, be in that downward trend and could go back to retest maybe 24,300. And similarly, if we look at the bank index, I would put those levels at around 54,200, and on the downside around 53,300. So that's the near-term thought that unless we can really get past some key short-term resistances, the trend is still down, and it could continue to be that way for a couple of weeks.
All right, and just about 3 weeks or so, 22, 23 days to go, Rohit, until the first anniversary of Sensex Nifty hitting their lifetime highs last year. And what a journey it's been, the kind of volatility we've seen, the kind of sharp corrections we've seen. For the long-term investor who had stayed on in the markets and had made some more investments during those lifetime highs, now seeing almost an entire year gone by, and we're looking at almost 6,000, 7,000 rupees points worth of correction on the Sensex. What should the strategy of those investors be?
So, for long-term investors, this is essentially a market in which you try to stick to your guns. If you have positive cash flow, you actually would try to add on the dips because you want to grow your portfolio. Good time to even judge where growth doesn't continue, specifically in mid and small caps. At least one thing is clear, that the mid and small cap segment is growing earnings at a faster pace than the large cap. So the thoughts that people had last year that the broad market would underperform the large caps, that's not really happening. In fact, it's the reverse. The only thing which has happened is that within mid and small caps, you have to really clear out the ones that are not able to keep up. So if valuations have gone up and your earnings growth is not adding up, those stocks are being left behind by the market. But there are segments, outside of that, where you're actually seeing positive performance as well, and the market is, rewarding those as well. So I think that part of the cleanup is what you would have been able to do in this last 1 year in terms of rejigging your portfolio a little bit.
Right.
But if you stick with the performers and with some of the themes, then you should continue to do well. Even if we just look at the last couple of days, for example, this sell-off from the 21st August down, we actually have strong performance in a couple of sectors.
Okay.
This could be the auto sector for one. Second is consumer durables, and the third is the manufacturing, related sectors, which have something in common with the consumer durables. But basically, these are areas that we've seen outperform. We've actually seen IT also hold up a little bit this time.
Right.
IT is not my favorite though, but I think the other segments do have a good reason for continuing these positive trends.
Right. We will talk about your not too favorite IT sector, but first up, let's bring up the charts for the auto sector and the consumer durables sector. And in fact, you did mention the auto sector, and the auto sector seems to be reeling under pressure. This could be the data that we saw for the month of August. Dispatches have been down, but a better time, festive season awaiting. So at these levels, when you're seeing the kind of price correction in stocks like Maruti Suzuki and M&M, would you suggest this is a good time to dabble into auto stocks, given that we know auto prices, at least by way of the tax incentive, the GST, are likely to come down, and the festive discounts are around the corner as well?
And keep in mind that interest rates have pulled down.
Absolutely.
And if the government really wants to step in and do more beyond the GST, you might even see further rate cuts in line with what might happen around the world. We are also seeing the US pushing towards rate cuts. So all of that is supportive. So I'll not look at only the one-day move, which is why I mentioned that the outperformance in the auto sectors happened over the last 10 days. They've actually gone up, especially two-wheelers have done pretty well. Everything from Hero MotoCorp to, TVS Motor have actually outperformed. So I think the sector on every dip is giving an opportunity to, be picked up for what lies ahead.
Right.
The auto sector should do well.
Auto sector should do well, but I'm also looking at the IT sector, not your favorite sector, Rohit, but the IT sector also has been pretty much a mixed bag, mostly on the negative side this last entire 1 year, especially since Jan the 20th when Donald Trump assumed office. Now, the Nifty 50 IT stocks have continued to underperform, and that trend seems to now be troubling investors who have invested in the India IT story. Again, a plethora of items surrounding it, one of course being the US interest rates, the second being this entire advent of artificial intelligence, and many saying that the Indian IT story is not geared up for that. At the same time, we've seen better performance from companies like Coforge and Persistent Systems. So as far as the large cap Nifty 50 IT companies are concerned, what should investors do at this point?
No, you got that right. So the approach here has to be very bottom up. It can't be top down. You simply can't go and pick the large caps within IT. In fact, most large caps in IT over the last 10 years have behaved like a defensive sector. When there's nothing to buy, people end up buying tech stocks because they'll at least give you that 5% earnings growth and or 5 to 8% earnings growth that they've been giving over a long enough period of time. But 5 to 8% earnings growth is not very, very attractive when you're in a market where the Nifty was growing earnings at double digits or more, and the broad market and mid caps were doing even better. So in that sense, I think the IT sector has just chugged along with the rest of the market, but it's not the place where you're going to make the big returns. If you have nothing in mind, yeah, you go and buy some IT. It might provide you defense. It might even help you because the currency is weakening. So in that sense, some people might look at it. But overall, it's not the large cap IT has not been the growth area of the decade. So
Right.
it's lagged behind most other sectors over a period of time.
No doubt about that. Rohit, I can't let you go without really talking the stock which is really driving the index up this morning, and that happens to be Reliance Industries. The stock is up about 1.6% or so in early trade. Now, of course, this coming on the back of, again, a plethora of news. To begin with, of course, the show of strength, the camaraderie between Russia and India on display at the SCO. And then again, the AGM of Reliance, one IPO a year going forward until the next 5 or 6 years. So overall, investors who are locked in or those who are not into a Reliance stock at the moment, is this a good time to accumulate some Reliance shares and really hope for the IPOs and the sort of split, the demergers, which are going to potentially yield more value? Or do you think time to be cautious because we don't know how global trade dynamics are going to play out?
Yeah, so see, Reliance, you're right. It's played a big role in this sell-off as well because it's the center of this entire oil fight.
True.
And as long as that oil fight goes on, it's hard to imagine that it starts to perform again. At the same time, when it does, it becomes very positive for the market. In fact, the oil and gas sector, even in the same time period that I was talking about, 21st August to now, has been among the worst performing sectors. So that pressure point remains. I can't specifically give a recommendation because we are not advisors, but it's just my thought that till this headwind is not behind us, we should probably not be in a hurry, to get back into this part of the market.
All right, Rohit Srivastava, let's leave it at that this morning. Thank you so much. As always, a pleasure having you here with us on Newsline.